All right, what's going on, guys? Welcome back to the MentiFX portal. So we just ended up covering in the last one, as you guys know, that win rates no longer matter, right? A lot of you should have already shifted your perspective away from win rates and having correct analysis and having correct trades and all the stuff that we think we need to do as traders, and shifted your perspective more towards I need to collect data, I need to learn to take many losses and many wins so that over time I can see profitability. And better yet, I should be cognizant of the fact that lower win rates can actually mean more profit and profit that is worthwhile. Now, that brings me to the next point that I want to discuss right here. And this goes back into our risk basics. And again, I'm going to walk you guys through this. I'm laying a foundation right now for an overall understanding of risk. But I want to start with the stuff that's most crucial and most important. And that is how we think in units of risk, how we understand and think about win rates or expected value and actually earning over time. And now how partly how risk to reward and actual risk works. So as you remember, in the last video, what we did is we discussed that you have the choice, right, of taking a trade. Well, where did my stop go? Jesus, here we are. So in the last one, we discussed the idea of the fact that when you take a trade, so let's just assume you're trading a 65-minute. Let's say this is your entry time frame, and for whatever reason, you want to take the trade right here. I'm specifically choosing this one because it meets break-even rules and ends up working no matter how your stop kind of looks here, right? Whether your stop is here or here. And one thing that I said is that as a trader, right, you'll end up having the final choice of how you want to risk on a trade. So your entire risk on a trade could look like this, right? So again, what is this line here acting as? Again, I'm just using the short and long tool on TradingView to set these up. Just like I taught you guys earlier in the simple risk calculations, and we'll talk about risk calculations soon again. But I'm just using those to plot them on here. This is the long position, and then you have the short position. There they are, right? You can screw around with these. I actually gotta change the colors to be equivalent on this one, so you can see the line is set to 0, the stop is set to the fourth at 14%, and then set to this color I made at 25%. So I'm gonna do that to this one too, 0%, set it to the fourth at around 14%, and set it to this color at around, what was it, 20%? 25%. So I'm just making these the same. This is just for colors. You guys can also set up these colors as you wish, but this is the long and short tool. And ultimately what's happening here is this gray area, or this part here, is acting as a stop. This is the area where you want to actually get out of a trade. So you guys saw me do a little bit of a breakdown on QQQ, which is very simply NASDAQ, right? Where I said, based on the kind of trader you want to be, there are many ways that you can actually enter a trade, right? You guys saw that, a trade can be something like this, and you hold for a move and you might take a certain amount of RR out of it. And you now understand how to calculate RR, or risk to reward, and actually do the math on that risk to reward based on your risk and stuff. And you also now understand how simply making the area through which you make one RR of risk smaller can easily increase your potential gain and your reward on any given trade, which means that over time, you will start to notice, as you guys remember from the last video, that a lower win rate, a much lower win rate, like substantially lower, can actually mean to a substantial increase in money and RR made. Now, something that I'm sure some people have a misunderstanding about or might be a little bit confused about is how can this right here, so this trade right here, or let's actually go to, let's just look at these two. How can both this trade right here, if it lost, so just imagine that this trade here lost, right? So it means it kept going down and hit the stop all the way down there. Or imagine this trade here, after getting tapped in, came down, and then also lost. How is it, let me make sure this is recording. It is, everyone looks good. How is it that this right here, if that happens, is considered a -1 RR? And how is it that this right here, if it took you out and went in for a loss, is also -1 RR? Wouldn't your losses be different or be bigger or smaller based on how big the size is? And the answer is actually no. And that is because of risk calculation. It's because of leverage and buying power. It's about understanding how you can put your own funds to work and how you can actually set risk given these parameters. So this is kind of where I wanted to lead the conversation, which is, or lead the next piece of your understanding of risk or risk basics. And that is, how can a different size stop still be considered always a -1 R? Because you guys already understand that everything from a risk basic perspective starts at 1 unit of risk, right? And I made it very, very clear now to a lot of you that whether you're taking a trade, let's say, something starts setting up, let's actually do a little bit different. So I know we've been doing a lot of double MB setups. So stuff that looks like this. specifically. But now let's use an example of entering through momentum MB on any given time frame. So that just simply means that, you know, price maybe starts a move and then you maybe get a momentum MB here and you choose to trade it and enter because you like the momentum MB. So something like this, where you just enter here, stop loss here, right? So how is it that if you were, let's do this, if you were to take this entry, right, and you simply put a stop loss, let's say right there, right? So like if we go inside of this, if you simply put a stop loss right there, like let's make it even smaller, like SL was right there. This is your entry, this is your stop loss. How is it that that right there, right, would be equivalent to -1 RR? And simultaneously, if you were someone that's still starting out, that's unsure in your system, or is testing to run a system with much bigger stops, how is it that if your stop instead of being here was down here, or even let's say all the way down below this low. So let's just say your system for some reason was you'd let an accumulation MB start playing out, you let momentum MB start coming in, you enter through momentum MB, and then you throw your stop loss all the way behind the overall thing because you know that demand is likely validating and now price may want to deliver, right? So you end up putting your stop here. How is it that similarly, this whole thing here is also equivalent to -1 RR? Right? How is it possible that both of these things are true, right? How is it true that both of these stop sizes would still be considered -1 R? And the simple answer to that, and you can write this down and we're going to talk about this in 1 second, is that this is possible due to your account sizes. It's in part due to how much we want to risk. So how much is 1 RR? How much is -1 RR for us? Is that 0.5%? Is that 0.2%? Is that 1%? Is that 20% if you're going crazy for whatever reason, or like 10%, right? It doesn't matter. You know, these are risk numbers. It's the amount we want to risk. It's about the actual asset we're trading. So we'll talk about that soon. How much it moves, we'll talk about that as well. And leverage, so margin, when and if available. Very important. We'll talk about margin as well. So how is it that these can it be equivalent to -1 R? What that means is, like, you know, if you're trading a $1 million account, how is it that if you enter this trade and have a stop here, that could be equivalent to a 10K loss potentially, right? So that's if price doesn't go and then turns around and takes you out. Or how is it that similarly, if price went down here, that would also be -10K. So actually, let me do it this way. So this would be -10K. And this would also be -10K. How is that possible? So the first thing that's very important to understand in terms of possibility is the fact that if you're taking a trade here, right, you're entering, this is your entry, you already know that, and you're setting a stop here, you can't just, without changing anything, move your stop here and have it be equal to -10K, right? Because ultimately, when you've already done the risk basics and done your calculations, this right here is always going to act as a $10,000 risk, which means if you increase that randomly to 1, 2, 3, 4, 5, 6, 7, 8, kind of 9-ish more, then your actual risk, if you randomly move your stop down here, is now going to be -90K, right? Because what you've done is you've moved a stop that was calculated with a certain amount of contracts or a certain amount of things that you bought, shares that you bought. And if you just move that stop loss, then of course your loss increases from the original, what would have been -1 R, because you're no longer risking 1 R, you're now risking a lot more. And this is important because this, again, is one of the biggest issues that plague a lot of traders. A lot of traders start trading, they learn maybe even some more risk basics. Like, a lot of traders don't even know the risk basics that you guys already understand, but some of them that do learn it end up taking proper risk. So let's say they take 1% or 2% or 0.5% risk right here. And then as price begins to go against them, as they see price starts going against them and starts coming down, they get scared. They get frantic and they take their stop and they slowly move it down. They're like, okay, maybe we can move it here and price can maybe play around and then start to move higher. But then price goes lower and it doesn't turn around. It turns around a little and then it keeps going. They go, okay, I'll move my stop a little lower. And the act of moving a stop loss, so you can write this down, the act of moving a stop loss after the risk is calculated increases your loss from your initial -1 R. So, you know, that's something that needs to be understood. So us moving the stop loss is not the thing that is determining that we're risking 1 R, right? The idea of risking 1 R is determined with our calculations that we do on how much we're going to actually risk, how much we're going to buy. I didn't even write it here, but basically, let me put it in: contract size / lot size / asset, or yeah, it's a basic contract size. We're going to call it contract size, right? But this is why it's possible for us to do something like this where this can be 10K risk and this can be 10K risk. And this comes back to the original equation where the question now becomes, if I did nothing more and just asked you this following question, would you rather have a system where you can risk $10,000 on this trade to make this much risk to reward on that 10K risk, or would you rather risk $10,000 on this trade for the potential risk to reward available there, right? Where like this delivery of price, an 11 RR delivery, would be a gain of 11 RR times 10,000, which is 1 RR, which is $110,000 profit, right? This would be a plus $110,000 profit on a 10K risk, because that's what minus 1 R is, right? So if I asked you the question of would you rather have a 10K risk on this or 10K risk on this, then your answer, especially if you understand how markets function and how risk functions, would always be to put $10,000 risk on this thing right here. Now, again, how is this possible, right? How can this thing be worth 10K and this be worth 10K? And this comes down to the actual contract size. You can write that down. This comes down to the contract size that you actually use to enter a position. And what you need to do is you need to understand how contract sizes are calculated and make sure that you have enough buying power. This is all stuff we'll talk about in a second. So everything will make sense to you by the end of this, and you will never have to learn about it again. But you basically have to make sure you have enough buying power to buy the amount of contracts you want to have the kind of risk you want. So you can write that down, right? The way that this right here is all made possible, where 1R can be 10K on a stop of this size, and 1R can be 10K on a stop of this size, is all possible because of, let's make this a little bit smaller. This is all possible because of how many contracts you buy, which is decided by if you have the buying power to buy them, to buy that many contracts, which is basically defined by your actual account size. But this is really the main point that you need to understand, is that all of this is possible, right? So how can a different stop size still be considered minus 1R, and how can they be the same value based on how you place them? It's not because we just move our stop, it's because we actually calculate, and it's all possible because of how many contracts we buy. And that's all decided by if we have the buying power to actually buy them. So in the next video, we're actually going to talk about determining contract size, which you already know how to do, but I'm going to show you exactly again, and determining if you have the buying power to actually buy them. See you there.